Recently, cryptocurrencies have taken a severe battering. For instance, the exchange rate between the US dollar and Bitcoin dropped from about $70,000 in early November 2021 to under $20,000 in late June and, despite ups and downs, plummeted to $19,733 on September 15. In the past, Bitcoin, by far the most well-known cryptocurrency, has been profitable for those who invested in it. 5 years ago, its value in relation to the dollar was less than $3,000. However, there are two areas where many Bitcoin supporters have been let down. This cryptocurrency failed to take off as a common form of payment and has shown to be a weak means of protecting one's purchasing power against inflation and turbulence. This is unexpected. The total number of Bitcoins available is 21 million. The majority of individuals anticipated that the cap would have led to a continuous increase in the stock's dollar-denominated price because more than 19 million units, or 90%, have already been issued. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. What is the future? It could be helpful to think about what happened in the past and make clear a few important aspects in order to predict future situations for cryptocurrencies. The first thing to note is that cryptocurrencies and their derivatives make up the blockchain ecosystem. For instance, while stablecoins Tether and Terra USD are cryptocurrency derivatives, Bitcoin is a cryptocurrency. These are tied to a commonly used and centralized currency, such the dollar, or derived from cryptocurrencies. Simply put, a financial investor gives money to a business in exchange for a derivative. The business transforms the cash into bitcoins before lending them to international customers. A defined amount of a certain cryptocurrency, maybe indexed to the dollar or backed by dollars, will be exchanged for the derivatives on demand by the corporation, which also guarantees doing so to the financial investor. The end result is that if you have purchased bitcoins or other cryptocurrencies, you will profit or lose depending on the cryptocurrency's exchange rate within your portfolio. However, if you have purchased a derivative, you might discover that it is not actually backed by a sufficient number of cryptocurrencies or that the dollar convertibility guarantee is, to put it mildly, porous. If this is the case, the derivative ends up being almost useless. This is what happened with a number of cryptocurrency derivatives during the past few months. Particularly if they offer fantastic returns that increase demand for cryptocurrencies and crypto derivatives, companies issuing such instruments are quite active on the market and help to make the underlying assets volatile. Investors will flee if the derivatives instruments are not adequately collateralized during difficult economic circumstances. The fact that cryptocurrencies are currently viewed as both a speculative instrument and a store of wealth, as opposed to a method of payment for routine transactions, is a second important aspect. In late July 2022, only about 250,000 bitcoins were traded daily, and it is likely that only a small portion of those trades were for commercial purposes. For instance, more than 60% of the total bitcoins in circulation are held in accounts with more than 100 bitcoins each and are hardly ever traded on the market. The owners of cryptocurrencies also appear to have a long-term perspective. For instance, shrimps and whales have both bought the dip in big quantities as a result of the current sell-off. The typical cryptocurrency holder's long-term perspective suggests that the project will survive dramatic volatility and is not an easy kill. Second, volatility has been caused by cryptocurrency derivatives, the activity of which has been amplified by the relatively small amount of cryptocurrencies traded on the market. And third, the 2022 crash in the cryptocurrency market has affected the derivatives industry and may have eliminated it. Based on nothing, but worth something. Of course, cryptocurrencies are not like stocks and bonds, which are supported by guarantees of future income streams, occasionally produced by a company's strong market performance and occasionally generated by a government vow to pinch taxpayers. Instead, cryptocurrencies are unbacked money units that will only increase in value when they gain acceptance as a legitimate method of payment for future purchases of goods, services, and other products and services. Every opportunity they get, central bankers and policymakers in general warn the public that cryptocurrencies are frauds. Christine Lagarde, president of the European Central Bank, has stated that regulation is necessary to avoid novice investors from losing all of their investment in cryptocurrencies because they are based on nothing and worth nothing. Ironically, digital currencies, which President Lagarde believes are vastly different from cryptocurrencies, are offered by central banks. Digital currencies issued by central banks do vary from cryptocurrencies based on blockchain, but not for the reason Ms. Lagarde undoubtedly thinks. The main problem is that decentralized currencies with a supply limit would do away with the concept of monetary policy entirely and turn central banks into an organization that controls commercial banking and generates data. It is understandable that the prospect has not delighted the central banking community. In other words, despite the fact that cryptocurrencies are purportedly false, central bankers do not oppose them. If based on nothing is fraud, then all central bankers should be prosecuted. Instead, they are hostile because they believe that broad adoption of cryptocurrencies would eventually threaten the privileges of central banking, which might have an impact on, for example, how public debt is financed. Scenarios. Policymakers and central bankers have three possibilities. Number 1. Ignore. They may disregard, forbid, or control cryptocurrencies. The initial action is the simplest. How come central bankers should bother? After all, the cryptocurrency industry is extremely competitive, and some currencies will vanish. Furthermore, they don't really pose a threat to money right now. It is difficult to switch from dollars or euros to one or more cryptocurrencies because each transaction still has a significant cost. A shift to cryptocurrencies would actually be tantamount to adopting an inconvenient double currency regime that many people would loathe as long as governments continue to accept centralized currencies like dollars and euros as the only means of payment. These regimes have existed in the past, however briefly. Number 2. Outlaw. A ban on cryptocurrencies would be pointless unless the government was concerned that significant crypto transactions might cause exchange rates for fiat currencies to become unstable. Additionally, banning Bitcoin must be a global initiative. If certain nations refuse to follow through, it would lose credibility. The primary issue with this strategy is that buying cryptocurrencies and futures is not illegal, and it is not at all clear that those who do so are working against the general welfare. Number 3. Regulate. The safest course of action ultimately appears to be regulation. The only real concern of the authorities is taxation because there is no plausible short-term threat to fiat money as a medium of exchange or proof of their usage in money laundering. The regulator is most likely to concentrate on this particular issue. The decentralized nature of cryptocurrencies has little to do with it. Rather, the tax collector has no way of knowing how much wealth the taxpayer has stashed away, and it would be extremely difficult to even determine whether an individual has an account. Future regulatory initiatives will focus on requiring greater openness in order to monitor and tax this type of wealth. The Market in Crypto Assets proposal was approved by the European Parliament at the beginning of July. If adopted globally, crypto asset providers won't be able to run their businesses without permission. In order to protect investors from fraud, this authorization will surely have conditions attached. In reality, these conditions will require that investors make their accounts public. Unless technology eliminates the need for authorized dealers, this is just the beginning. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.